Hi, welcome. Come in.
This three-bedroom apartment on Sydney's lower North Shore has had a price reduction.
So this Chatswood property was on the market with another agent for about 1.8. We've come in, we've listed it again 1.6.
$1 million views in a market coming off the boil.
A lot more properties that aren't selling, a lot more properties are coming off the market, are being expired, more than we have seen in the last 6 to 7 years.
You just need to be really realistic about your price because credit is tighter. People can't borrow as much as they used to.
That's because of tighter rules by the corporate regulator and the fallout from the Banking Royal Commission designed to limit risky lending.
Generally speaking, most of the cycles have been driven by interest rates. This one's been driven by tightening up of credit and the reality that affordability had really hit home in a very negative way in Sydney and to a lesser degree in Melbourne.
But affordability has improved slightly as house price declines accelerated in 2018.
I wouldn't be surprised to see values falling, another 4 to 5% over the next 12 months. Maybe even a little bit more than that in Sydney and Melbourne.
Let's not forget that this is at a time where there's been a lot of supply added to the market, and the market, particularly for Sydney and Melbourne, when you've had anything from 50 up to 70 to 80% price growth in a 5-year period, a correction was warranted.
The correction has the attention of the Reserve Bank, which is tipped to leave official interest rates on hold throughout 2019.
I think as long as it's orderly, I don't think they're very worried at all.
There are risks though.
It's overshot on the way up. There's no law that says it can't overshoot on the way down.
Including a shift in mortgage products.
The increase of interest-only loans in the last 4 years has probably been to a degree that staggered me.
Many of those loans will switch to principal and interest next year.
They're not going to default on their loans because of that. My guess is they'll probably cut back on their spending.
Dire predictions of a full-blown crash would need an economic shock leading to a dramatic rise in unemployment.
As we head into an election year, there's also the implication of housing policy. Labor wants to limit negative gearing to new homes and reduce the capital gains tax discount from 50 to 25%.
It's also going to have repercussions for the resale value of those properties.
Others aren't so sure.
Western Australia's had negative gearing for the last 4 or 5 years. House prices have been falling. East Coast has had negative gearing. House prices have been rising.
But given the recent weakness,
will they tone it down a bit? Potentially.
As for those intent on finding a bargain in the new year,
regional Victoria and regional Tasmania at the moment we're still seeing growth, and I wouldn't be surprised if we continue to see that. Markets like Brisbane and Adelaide and Canberra are still showing growth in values.
Although the days of double-digit growth are well and truly over. Ricardo Goncalves, SBS World News.